Buckle up, ladies and gentlemen. You're in for a bumpy ride. Has the stock market started its sell-off? Is this where the market starts to head a lot lower? In today's video, we're going to be diving into the technicals and potentially calming down a lot of people because today's market sell-off looked pretty scary. Donald Trump came out, stock market at all-time highs, and then pow! Almost immediately thereafter, being one of the best signals so far for the market to sell off. Now, you're watching the Daily Stock Market Brief. My name is Michael Silva. If it's your first time here, I am just a regular dude in his house. I work 40 hours a week outside of this, so I do these videos absolutely free and because I really enjoy doing them. We look at multiple indices. We're going to be looking at multiple indicators, signal charts. We're going to be wrapping everything together in the conclusion. Today's video, by the way, is very important to really understand. So you're going to really want to hear out the conclusion section because it's going to give you a good view as where we stand in the market. If you like this type of stuff, make sure to subscribe and smash that like button. Let's get into today's show. All right, ladies and gentlemen, we're going to start off with the indices, starting with the S&P 500. Okay, we're going to go into daily time frames and then 30-minute time frames. Let's look at the daily time frame. What do we got going on here? Very scary day, right? We gapped up and we closed below the previous low of the previous candle. This right here is an outside trading day. Notice how we have a higher high and a lower high, and it's a bearish engulfing. This right here is a reversal type candlestick pattern. Does that mean anything right now? Well, we're going to be getting into some more charts to really determine if this is meaningful or not. Now, keep in mind the context. Still very bullish, all right? We still have a lot of support to break through for the bears. So this right here, when the bears get a hold of the 5 EMA, so when the price action closes below this squiggly little line here, the frequently tagged EMA, it has not held there for very long. You see a lot of times that the market just buys right into that price action. Okay, so we have the next support level right around 36.50. Notice this trend line here. You have this gap below us. And yes, we have been filling some gaps, which aren't not structurally sound. And then we have, once again, this horizontal support, the gap, which is active support, and this trend line. So yes, overall, bearish looking candlestick pattern. Yes, we closed below the 5 EMA. And yes, all crashes typically start in this type of fashion and or pullbacks, I should say, or corrections. They start like this, but you must get confirmation and follow through in order to know that this was the beginning point. It's a very strong possibility with what's coming out tomorrow. We have the ECB, EB, we have in next week, I think the Fed talking about programs around more stimulus. We have the possibility for more vaccine news. Just it's limitless possibilities to just jam this market higher. And like I said, we're going to be getting into a lot of charts today, so buckle up. Let's look at the 30-minute time frame. RSI, negative divergence. We called out this rising wedge, and I said it looked like it was going to potentially break down or, burst up to the upside and we'll get more moves. We broke down to the downside, okay? We closed some little gaps, and then we have somewhat of a positive divergence right here, and we started seeing a bounce towards the end of the day there. So are we going to get followed through back to this lower trend line, maybe fill this gap right here? It's very possible. Just notice the structure is still a bull channel, so just one down day doesn't really honestly mean anything, okay? So let's look at the Dow Jones. Dow Jones still remains within this very tightly coiled structure. A few days ago, we talked about the market is coiling up for a big move, and we're starting to see some very back and forth action. Notice the gap up, pinned, it tagged the top trend line, and then it closed. It went below the previous, so it was an outside trading candle. But mind you, we got jammed back up to the 5 EMA. All right, so it's interesting price action. The bears might have, I didn't have the legends up right now, so I can't really tell, but it looks like we're sitting on the 5 EMA. If you just look at the past 3 days, what have we been doing? Well, hit the 5 EMA, jammed up to the top trend line. Opened up the next day, came down to the 5 EMA. The next day, same thing, jammed up. And then the next day, boom, same thing. So we've been chopping back and forth. There's no victory right here for the bears and or the bulls. But what I can tell you, this is not structurally sound. This big move to the upside right? And the pattern itself that it's forming. It is more bearish, but mind you, it's in bullish context, all right? And like I said, in the conclusion section, we'll be getting more in depth. Here is the 30-minute time frame. Negative divergence on the MACD, negative divergence on the RSI. We have the price action continuing to move up higher and higher. Today, yeah, we had a down day. We're still above 30,000, right? It wasn't that big of a down day by any means. But maybe we should watch out if we start breaking below these levels. Maybe we're going to coil tighter and tighter and tighter until we get some rug pull or potentially just good news that shoots this market, a lot higher. Okay? So we'll keep on moving through. One of the things that kind of concerns me within the Dow Jones composite, okay, the DGA is the composite index. And then you have these three right here that make up the composite. So we have transports, the industrials, utilities. You probably heard of Dow theory before when it looks at the industrials and transports. It's a good measurement on the economy because, you need, if industrials, if we're creating, if we're producing as an economy, we should have high transports as well to get all those goods and travel and et cetera, et cetera. But what I find interesting here is the divergence taking place in utilities. Utility has been sinking since basically just early November. Meanwhile, the transports, the DGA, and the industrials have been going up. Now, this typically, all of these here should match with the Dow Jones Composite Average, the DGA. They should all move in unison. So when they start diverging, maybe for a couple of days, that's not a big problem at all. All right? But for weeks or months at a time, that is when we have to start taking notice that that divergence can eventually turn into something bad for the industrials and or, the transports, et cetera. Let's look at the Russell 2000. All right, so Russell 2000. I actually, when we get into the 30-minute time frame, I'll call out what I put out on Twitter. And most people thought it was probably a dumb idea, but it paid out. But what do we got going on today? Strong gap up. We talked about this in yesterday's market brief. What would look bearish? A big gap up or a large gap up, and then a close bearish kind of day, the remainder of the day. So what took place? We gapped up, we came down, we tagged the 5 EMA perfectly and jammed up further. This ain't in the bear's favor by any means yet. All right. And I have this little red box checked here just so you can see what happens sometimes. Yeah, it looks bearish, but we didn't capture the 5 EMA, so it's still in the bull's control. What happened here when that took place? We gapped up, came back down. Well, we ramped up. Same thing here. Boom, came down a little bit more, but we ended up ramping up. Same here. We gapped up, closed down, and then boom, we freaking shot higher. All right. So this is nothing. Don't be too certain that this move has stopped. Now, this is how, like I said, this is how selling pressure begins, when you see candle formations like this. But to the narrative, we need confirmation in order to make sure that this is going to be breaking down. And mind you, all these gaps to the upside, this pattern that we're seeing right here, yeah, and the RSI is still overbought. To me, that looks like a perfect opportunity for it to start aggressively moving lower, but it's not necessarily going to happen. Here's the 2-hour time frame. We broke down through this rising wedge pretty sharply, and then we immediately recovered, and we're still below it. Okay, we back tested it. Now, like I said, people have been buying these little dips. So maybe this is the start of something, but maybe it's not. All right. Here it is on the 30-minute time frame. Yesterday, this is what I put out on Twitter. I said, this is a good opportunity to hedge short right around here. We tagged the top on that tweet. Okay. What did we wake up to this morning? A huge gap up. Now, not huge, but it was a relatively large gap. And then immediately following selling off to the lower trend line. And then I scaled out of that position right here because I wanted to capture some profits. And notice when it comes to this trend line, we're starting to see it bounce from those levels. So we got to be careful here because, like I said, the market can continue to push higher. We must get confirmation. Nasdaq 100. Now, what have I been saying about the stairs up and the elevator down? Let me just point this out. 1, 2, 3, 4, 5, 6. 6 days of price action drifting higher, 1 day to wipe it out. Okay? Stairs up, elevator down. If that kind of pressure continues, it can get significantly worse. Look over here when we saw this big run up. In 3 days, we wiped out basically a month of gains. So, yeah, we're drifting higher and higher, But keep in mind, like, just what's taking place here. Now, this candlestick is by far the most bearish, and the Nasdaq 100 got beat up the most. The QQQs were down 2.15% on the day. We were overbought, and then we got that sell-off. We saw this trend line, and we were mentioning, hey, if it breaks down from that trend line, you know, we can see some selling pressure. The bears have the 5 EMA, so we're below it. But keep in mind, this 12,200, still a level of support. Why? Because it acted as resistance, 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 and then when it broke through, we started drifting higher. Okay, so this level still is an area of support. Mind you, too, we have the 20 period sloping into that area as well. So if the selling pressure continues to push us lower, where can we look for a potentially buy opportunity? Well, I would say the best opportunity is around, I would say focus on the Nasdaq because it has been relatively one of the more stronger indices. Now, notice the lower Bollinger Band contracting up, and then you also have this symmetrical pattern right here. This right here could be a potentially good zone to buy the dip, and then obviously maintain your stop losses. This was the 30-minute time frame. We called out this breaking portion right here, and then we saw the ramp up, and we mentioned, okay, still, I kept the pattern because it still looks like it's potential possibility for it to continue to move down. And boom, today was just a solid break to the downside. Now we have a positive divergence on the RSI, and we're starting to see a bounce here right around this gap right here. So, you know, if you bought in long right here, that's not necessarily the worst idea because the market has been buying these dips and you have this positive divergence. It would make sense to see some sort of a bounce here. And, you know, I mean, mind you, it's the 30-minute time frame, but we're overextended to the downside here on the Bollinger Bands. So yeah, make sure that, you know, if you did go long here, we might see a bounce. But if you start seeing weakness, that could mean that it's a dead cat bounce, so we could head potentially lower. All right, that would be a lot better to see this market start rolling over at this particular point in time, leading into the Federal Reserve meeting, because then we can clear out some of these gaps and start looking for positions to start going long again. All right, now here's the semiconductors. The semiconductors make up a big portion of the Nasdaq. So when semis take a big hit, you can expect the Nasdaq to go down too. Well, what do you know? Almost 3% down for the day. We had this rising wedge. We've talked about this for quite some time. Close below the 5 EMA, close below this lower trend line. Maybe we might tag the 20 period and then find some support there. But keep in mind, you know, these dips have been getting bought. We need confirmation. This little candlestick formation right here where we started this big green candle, move up a little bit higher, and then just wiped out a couple of days of work. That's pretty bearish in my opinion. So we'll see here if it could continue. Now keep in mind, we're still like pretty high up on the RSI. We're still relatively high up on the Bollinger Band. So maybe we might be taking a little breath here before we move higher and then create a negative divergence, which can then send the market a lot lower. But, you know, we gotta play that when time comes. All right, guys, now, and gals, we're here at the indicator section. Gotta take a drink of water. I'm running out of breath. Yeah, breath. Breath is good. We're gonna be going over quite a few charts, but I'm gonna walk through them quickly. Here is the VIX, falling wedge. We broke out a couple of days ago, but it was drifting lower. We pointed out that it was kind of curling up. What do you know? We saw some volatility pick up today, 22.27, up 7.69%. Are we going to continue this move higher? Maybe. Let's see what happens. We got to get above, probably right around this 23 marker to see it squeeze up higher. I still think 27.50. If this sell continues, would be a good area right there to reach up to. But you know, we still have this gap below us. And we have some news and some big stuff taking place this week and next week. You know, maybe that just shoots us right back down to fill this gap and then potentially create some negative divergence in the indices to potentially go lower. Let's look at the CPC. This is the warning signal. Warning, warning. When it crosses below the red line, it's, you know, hey, be careful around these areas. Make sure you're taking profits. When it crosses back above the red line, that is more of the sell signal. Sentiment of the market has been so complacent, so bullish. And what do we see here? Well, we saw this point right here, we call that a double bottom, right? And now we're starting to see it kind of curl up. If it continues to move up, I would expect the market to continue to sink down. If we see a very aggressive spike up and we start seeing it cross above 8.0, you never know. That'd be the warning, or the sell signal, and we might get even more an aggressive move to the downside. We're not there yet, so don't get all crazy about that. But keep in mind, too, last time I hit this double bottom, we had an aggressive move up to the upside. It was right here in September, and then we sunk lower, all right? And then not to mention, the markets are completely complacent. This is the monthly time frame. We're looking at the S&P 500 and then the CPCE. The last one was the CPC, which is the total put to call ratio, taking this index right here, CPCE, and the CPCI, which is the put to call ratio on the indexes. So what do we got going on? Well, first off, we're at 0.42, extremely still complacent. And when it hits these low levels, I just wanted to point out, which we pointed this out. Okay, we pointed this out plenty of times. When it reaches down to 0.45, you can expect volatility to get pretty darn intense for the next 5 months. And we measured out what the next 5 months look like. And as you can see here, more close up and zoomed in, this level, yeah, it went down a little bit. When it hit this, yeah, we went down quite a bit. When it hit right here, we saw this ramp up and then we saw this drip down. Okay, we saw this move right here and then we saw this little move down. We're still really, really low. So we might very well be seeing something where we got that big ramp up, and we get that, big move to the downside, and we might get that one big move to the downside that can fill a lot of the gaps in the NYSE, in the Nasdaq, in the S&P 500, et cetera, et cetera. Now, the BPNDX, this is the percent of stocks that are on buy signals. 71% of the stocks in the Nasdaq 100 are on buy signals based on the pointing figure charts. Negative divergence on the RSI. You can see the price took a little bit of a toll today. So if we've been looking for that, it's there. I thought we might get to overbought again, but we didn't quite reach it. Negative divergence. Same thing with the S&P 500. This is BPSPX. Negative divergence. It's kind of playing out right here. Maybe it'll continue, maybe it won't. Then we got the NI high low jammed up 98.51. When it reaches these extremes, which I don't even know if it ever reaches these extremes, I have to go back farther into history, but that's a super, super, super high level. And if it has, it's been very far and few times in between that this has ever happened. Not to mention when it gets up to these extreme levels, you can see these blue vertical lines, you get pullbacks. Breadth, 2760, down a little bit, negative divergence on the NIMO. Maybe that's the start of when we start pulling to the full on negative breadth and the market pulls down. But keep in mind, like I said, we can still have a market go higher on a negative breadth as proven in 2018 and right here. So nothing crazy. And if you want to look at this at less than a contrarian type of view and a more positive view, you can say here, what are the percent of stocks above the 200 period moving average in the S&P 500? 91, basically 92% of stocks are above the 200 period moving average. Okay. There's S&P 500 has like 505 stocks or something like that. So over 480, 490 stocks, right, are above the 200 period moving average. That means the breadth of the market is extremely strong, which can be viewed as very, very bullish. But look at the aggressive move pushing this up, boom, to the upside. And sometimes when we hit these extreme levels, yeah, it can hold up there for quite some time. But notice here in history, I've marked the times when we see it sink. Down 9%, 5%, 7%, 16%, 20%, 7%, 8%. Like I said, if we see a 10% drop, that's going to fill a lot of the gaps in this kind of unstructurally sound market. We have the fast stochastic here on the summation index. This is something that I learned once again from Sven Henrik. I really like him. If you don't follow him on Twitter, I'd say follow him on Twitter. He always posts great stuff, and he's pretty comical for the most part. But this one I really like to use on occasion. It is max overbought. I like to look at it at max overbought or max oversold. When it gets max overbought, sometimes we get significant sell-offs. Sometimes when it gets down here, we get significant rips higher. And then we have the NIM exposure index and the RIDEX right below it. This is what asset managers, are doing with their money. And then we have the RIDEX, which also shows us, where is some money going. And it's a sentiment indicator. Are they bullish or are they bearish? And I can tell you right here, the RIDEX, extreme bullish at this level. NIM exposure, extreme bullish at this level. That means that sentiment is extremely bullish. Yeah, you can look at it as, well, that means the market's going higher. Or you can look at that as, okay, everyone's bullish, which means it's time to start preparing to get a little bearish and or just, prepare to take some profits. There we go. That's what I'm looking for. Then we got the NOL, the new high-low index, pumping high. Super, super, super high, over 400. And then what do we got over here? This was, last time it reached that high level, you can see that was right before the crash, but the market continued to move higher on a lower move on the new high-low index. So that was a negative divergence. Maybe we might see something similar. Maybe this is just a slight pullback to rip higher, and then we get a massive move to the downside, correcting a lot of this, just crazy market activity. Then you have the Nasdaq 100%, or the Nasdaq 100. This is the percent of stocks above the 200-period moving average. Like, we call this out right when it got to these extreme levels, and we marked out these blue vertical lines saying, yeah, sometimes it market can go higher, but also it sometimes ends up converting or pulling back. The market ends up pulling back. And right now we're pumping 89% of the stocks are above the 200-period moving average. It's pretty aggressive, right? So that's a high level, which means there's a lot of breadth in the market. That's very bullish. But sometimes when things get too bullish, it's time to get bearish. Let's take a look at commodities. Commodities. We'll start with the CRB. Third day in a row, traded below the 5 EMA. It was pretty bearish looking, but then it kind of caught a bid, and now we're kind of sitting at the 5 EMA. Not going to read too much into this at this particular point in time. The CRB is a widely tracked index, and not just by like traders. This is by, the Fed will look at this. We have big banks looking at this. We have people in agriculture looking at it. We have so many different people looking into this. This is a great tool to see, what's going on with inflation. I mean, mind you, this works inverse with the dollar. The higher this goes, typically you'll see the dollar go down. Now the MACD did cross over. Okay, that's a bearish sign. The RSI is still trending decently. We're below the 5 EMA. This could be a bull flag, or this could be a potential move to the downside. Now what I find interesting is the CRB typically moves in unison with gold for the most part. And since August, the CRB has been going up. But since August, for gold, now mind you, gold had one crazy rip into August, but it's been drifting down since August. And I said that gold looked really, I wasn't convinced on this move to the upside yet. Okay, and I'm still not truly convinced. And when it reached this level, I said, be careful here, and then boom, we got that sell-off, a pretty aggressive sell-off to the downside. Now, are we going to get continued weakness? It's possible. I would say now, if we start crossing below 1780, I think it's very, very possible and probable to reach down to 1750. So we got to keep our eye out for this to see if this downpull here, and then we're seeing this strength, lower high, right? A lower high is not good. And then if we break the previous low, that means the trend for lower lows also is continuing, meaning it's in short term, because we're only looking to August, short-term downtrend, all right? Then we got silver. This whole candlestick pattern right here is pretty bearish. An evening star, I don't know what you want to call this, but we cracked above the 50 period. We tagged the upper trend line in an inverted hammer. We had confirmation to the downside. If we start getting below 2350, it's an easy tag down to 2250 to 23. If we start breaking below that, 20 period moving average, or 200 period moving average right down here would be that next target. Now let's take a look at the dollar. The dollar slightly moving up day after day. All right. Nothing crazy here though. But notice the higher lows building up. And we're getting higher and higher. We were up 0.11. We're now closed at 91.08 when we were trading, below 91. Maybe this is a move to move up back up to 92. And, maybe gold will continue to fall. Like I said, this was like a big fake out to me. Like I knew this falling wedge was going to result in one, gold breaking out or breaking down, and or the dollar breaking up or breaking down. And the dollar went down. Gold hardly moved. Gold hardly moved when the dollar crashed below 92. And this was a very fast, aggressive move from 92 down to 90.5 in 3 days. That in the Forex markets, that's a big move. And it's a fast move. All right? But gold hardly budged for this type of move. And now we're starting to see gold fall pretty significant today. And it wasn't even all that big of a move here. So it's a confusing time, but I'll tell you this, on the weekly time frame for the dollar, falling wedge into this area of support. And like I said, the CRB index moves inverse to the US dollar. So if we start seeing the US dollar break out, we have a positive divergence there, positive divergence currently on the MACD, bullish pattern, we're at support. Then you look at the CRB, like I said, yeah, maybe this is a bull flag and we go higher and then the dollar continues to break down. But, time will tell. This is moving into some areas of resistance. Meanwhile, while the dollar is moving into some areas of support. This chart right here, This was on, oh, this was yesterday's. I didn't even update this, but this was just to show you the correlation between the two. The dollar's down here, the CRB's here, moving into an area of resistance. Dollar's moving down into an area of support. My bad, I didn't update that chart. Let's look at bonds. Not much to report here. A little bit of a down day, right? We've been ping-ponging around in this bearish channel, so they've been going lower, which means what? Yields are going higher. When we take a look at yields, yeah, we're not above 1 yet, but just pay attention to the trend. The trend right here has higher lows. That means the trend is, the short-term trend, right, is moving up higher. Now, mind you, it's coming from an area where we had a sharp, sharp decline. So yeah, we're pricing in growth and inflation. That's what the bond market's doing. You see the spreads moving up and increasing as well. So we got to continue to monitor this for either sharp moves to the downside, sharp moves to the upside, or just a continued drag moving higher and higher. Mind you, like banks will do good if yields continue, the long end yields here, the 30, the 10, continue to move higher because they borrow short term and they lend out long term. However, when yields, and mind you, this is a long way to go, but when yields get more or when they go up higher, that might be good for the banks, but consumers typically spend less or they buy less bigger goods. For example, houses, cars, school, whatever the case may be. Bigger amounts of debt are typically harder to manage, and debt levels have been flying through the roof. So how high can yields go until we really start feeling the pressure? And we don't know what the Fed's going to do here coming up on the next meeting. So we'll see what all that bond buying or yield curve control and all these other things being thrown out in the markets are being told. All I got to say is if you don't understand economics, and I'm not by any means a professional at all, but if you don't want to look at all the individual metrics, the economic metrics out there, you can look at the bond market. If you understand and track what's going on in the bond market, they're pricing that in. The bond market prices all of that information in. So it's, makes our job easier for analysts or chartists or whatever. Let's wrap up to the conclusion section, everybody. We went over a lot. Now let me wrap your head around everything. The main question we asked was, is the stock market selling off now? Is it the time to go short? Is it the time to take off all your long positions? Well, like I already stated, that's not a simple answer. It's not a yes or no, okay? But let's give you context into it. One, if anybody is telling you, yes, this is when the market's going to crash, or no, the market is going higher, they don't know what they're talking about. They're just saying something for the sake of saying something because there is no confirmation yet. We need confirmation to know what's going to take place. And as I see it, let's look at the more broader view, okay? The more broader view to me is this. Why won't I go long right now at this particular point in time, despite that the market might move higher? Well, based off my signal charts, my indicators, the price action, it's not good enough for me to go long right now. And yeah, I might miss out on even a bigger move higher. But guess what I won't miss out on? A strong move to the downside, right? And mind you, also, it takes a very short period of time to wipe out a lot of gains. Look at these two drops, 1, 2, these two candles, that's 2 months, a low, all the way back here to 2016. So in 2 months, we wiped out gains from all the way to 2016. Stairs up, elevator down. Okay, now why wouldn't I go along more specifically? One, we're disconnected from the 5 EMA on the Russell 2000. This vertical freaking move, we're disconnected from the 5 EMA and we're trading above the upper Bollinger Band, above the 5 EMA by 6.7%. The most frequently tagged moving average, we're above it by 6.7%. That's pretty bonkers. What else? Monthly time frame, yes, 6.7% above that. Negative divergence. What else do we got going on here? Oh, remember I posted on Twitter from Tom McClellan? He posted the PPO and he showed some altering settings on there which make it very helpful to know when things are very overextended. So I changed my settings to 110 for the monthly, 1,10 for the PPO, and look at this. The percent of stocks, basically the percent extended from the 10-period moving average. We are at a significant high. A significant high. When's the last time it crossed this threshold? It tapped right here-ish, and then it tapped right here in mid-2010. So yeah, we got up to that level, and then boom, a pretty striking move to the downside. I mean, this is a log chart, so yeah, 60 down to, you know, a low of 50. I mean, that's a big percentage point move. I should have measured it. And then right here, we kind of tapped it. Up here, big pullback. And then where else? Right here, you know, we saw that big rip to the upside and then a pullback. All right? So things are overextended. Anybody will tell you that the market's overbought, but that doesn't mean that the market can't go higher. All right? Then we have the Dow Jones on the monthly time frame, tagged the upper Bollinger Band, still disconnected from the 5 EMA by 3.5%. The monthly Bollinger Band. When we get that disconnected like we did here or here, what happened? We rip back down. Here's the S&P 500. 4.2% extended on the monthly time frame above the monthly 5 EMA and trading over the upper Bollinger Band. Is this a good time to go long? I mean, you tell me. Maybe you guys all know something that I don't know, but based on just technicals purely alone, this is bonkers, and we need to be a corrective movement. And if it doesn't get a corrective movement, the corrective movement, when it eventually comes, and it will be just that much worse. All right, so overall, you need confirmation to make sure that this market's going to continue to roll over. As I see it, the market has been buying these dips. We have the Fed meeting, we have ECB, EB. We have all kinds of stuff going on, which can very well just propel this market significantly higher. So be very careful if you're holding puts. Me personally, I like hedging over extended moves, and I scaled out today of the IWM. I'll be looking to go long on the Nasdaq or individual stocks if we pull back to some certain key levels of support. That's all I got for you on today's Market Brief. See you later.